There's a significant reason why analysts constantly get this wrong. Their predictions regarding tech companies, they have fatal flaws sometimes. My name is Michael Kubera, let's get into it. In Poland, I always told you guys that the internet was fantastic. It's so much cheaper than in America thanks to Comcast and Warner Brothers monopolies. But unfortunately, when moving addresses here, I went a little bit outside of the main city. It's cheaper and this building is from 2018. I'm the first resident here, and unfortunately due to that, this company decided, well, you're gonna have to wait a very long time for our internet. They do have 1 gigabyte available, but I switched companies and I'm sick and tired of using my hotspots. I know I'm complaining about 20, 30, sometimes 50 megabytes, but after 3 months of waiting, next week we should have 1 gigabyte. So if my live streams have been a little bit choppy or it's been difficult uploading videos, please understand that, and there should be a slight improvement. Also, I discovered there is a company with 10 gigabytes. 10 gigabytes. It's just not in this area. Their area is about 2 hours away. 10 gigabytes. I could upload a YouTube video within a second. You could download a 100 gigabyte game within a minute. Like, that's insane. That's insane. I wanted to throw that in because it shows that technology is at an ever-expanding rate. It's progressing. Convenience for the customer, that is the #1 most important thing. Thank you, technology. Let's get into crypto. This is your blockchain on brain.
Honestly, I was just so impressed. 10 gigabytes, that's so, oh my goodness. Technology is wonderful. What happened to Bitcoin? What? And Graham Stephen is at 267,000 subscribers, I've mentioned, because this guy is making an incredible profit just from his YouTube videos alone. This is why it pays to have a finance channel. By Graham. CNBC, battered down Bitcoin jumps 15%, lifting cryptocurrency market value by $20 billion. This is from 14 hours ago, while around 48 hours ago, Bitcoin is down more than 80% from last year's high, nearing its worst ever bear market. Now, CNBC, we all know that this is a super reliable source for your cryptocurrency news. You know, there's actually an expert on this topic. Mr. Jordan Belfort himself recommends CNBC for cryptocurrency following, although I wouldn't recommend Jordan Belfort to you guys. I mean, do remember that this guy still owes the government tens of millions of dollars for restitution for the victims of his scam. Coin market cap, where are we with Bitcoin? It's at $4,350. It's up 6% and it dropped to $3,500, and that's why everybody was panicking. They were freaking out, and they might have watched this video chatting with an expert on Bitcoin when Lambo on the moon, and they might have commented something like, I'm an expert on losing my net worth trading cryptocurrencies. Well, today's video is going to look into tech companies and why analysts frequently get them wrong. We are on Forbes.com currently, and we're going to do a quote here. Analysts are paid millions of dollars a year. Their firms have the most expensive algorithms and predictive models, and yet they consistently miss the mark with their predictions. The market, however, responds to these reports as if they were gospel. Of course, when a big powerhouse powered by quants from the best Ivy League universities around the world, when they release their newsletter or they go out on video, the CEO says something, or on Twitter, everybody's going to be following them, right? Because these are the institutions in Wall Street that have been around for quite a little while, or they're coming from Silicon Valley, or maybe it's Mr. Warren Buffett from Omaha, Nebraska. Whatever it is, they will have their good days and their bad days. Analysts are prone to groupthink. Once one analyst changes their rating or price target, others quickly follow suit. So when they pick the right thing, fantastic, everybody makes money. But if they mess up, then everybody loses billions of dollars. Oftentimes this happens after a company surprises with an earnings beat or news about the company is released. At this point, the market has already priced the news into the stock long before the stock opened, and that's actually the problem, or sometimes the advantage, depending on which side you're playing on, when the stocks are only available for purchase and selling at specified hours. Now with cryptocurrencies, that doesn't exist. That's why you can go to sleep and holy moly, you wake up, everything is completely different, and it might never return to that point ever again within a couple of hours. Some people absolutely love that risk. Now, I did mention one figure earlier, and he doesn't fit in with the rest of them. Now, sometimes he may come out with other analysts, but for the most part, he goes against them. He just does his own thing. Many analysts look up to this individual, and his name is Mr. Warren Buffett, Emperor of Nebraska. He increased Berkshire Hathaway's stake in Apple by 75 million shares. This was at a time when everybody was saying Apple might have a little bit of a problem. Mr. Warren Buffett bet against analyst reports, and he quoted, "The idea that you're going to spend loads of time trying to guess how many iPhone X's are going to be sold in a 3-month period totally misses the point. Nobody buys a farm based on whether they think it's going to rain next year. They buy it because they think it's a good investment over 10 or 20 years. Apple was one of the first companies to reach the $1 trillion market cap." Analysts use something called channel checks, where they go into, let's say, the Apple store, they interview employees, they go online, they ask around, they go to the suppliers of Apple in Taiwan, and they form an opinion based on that, and sometimes, or most of the times, its accuracy will be, well, a failure. Mr. Tim Cook, the CEO of Apple, has this quote, "I'd also stress that even if a particular data point were factual, it would be impossible to accurately interpret the data point as to what it meant for our overall business, because the supply chain is very complex, and we obviously have multiple sources for things. Yields may vary, supplier performance can vary, the beginning inventory positions can vary. I mean, there's just an inordinately long list of things that would make any single data point not a great proxy for what's going on." So a lot of people had problems with Apple, but a lot of people also made money from Apple, and it's currently, if you go on Yahoo, at 181 bucks. Market cap is at 858 billion. But don't worry, we're just warming up here. There's two companies in particular that a lot of analysts had issue with, and these companies fit right in line with what crypto is about. It's the latest technology, and here is a perfect segment from How Did Tesla Make $13 billion in 13 Days? All the links used in this video will be in the description below. This is from Curious Elephant, a fantastic video, but this one screen here shows everything. Financial experts look at analyzing statements and managing perceptions, and they're really, really good at that. That's their specialty. But technology experts need to understand the tech aspects where the financial experts may not really get that. Financial experts also are looking at quarters and how they are going to make their investments seem worthwhile to their investors for this quarter, for this year. They need answers now. Tech experts are looking 10 years into the future, 20 years into the future. This is why you have billion-dollar unicorns like Lime startups with scooters, or why Uber became a unicorn, because Uber wants to be the Amazon. They're not the Amazon of travel yet, and they're not going to be that for another couple of years, maybe even decades. But more so, it's seemingly like they're going to dominate the travel industry. This stuff doesn't happen in a year. And unfortunately, many financial experts, well, they just can't look that far ahead. They're forced to under their circumstances. And that's for a reason. I mean, in the past, there's been many companies that have failed, so financial experts have just stuck to what they're best at. But with Tesla, for example, a lot of people were frustrated and confused. They didn't understand, how did Tesla jump up? Elon Musk made $13 billion on Tesla. Okay, he didn't make that entirely himself, but I'm sure he got a pretty big portion out of that. And the reason for that, mind blown. Analysts hugely wrong on Tesla in Q3, wrong on Tesla for years, yet still bearish on Tesla. The power of denial is an amazing thing. Yes, there is always plenty of debate possible about the value of a company, whether its market cap and stock price should be higher or lower than today, but there isn't debate about something else, and that is history. Tesla's Q3 financials report is one example of many showing how incorrect Wall Street analysts can be about something even simple clean tech bloggers can understand. Goldman Sachs, everybody's favorite in cryptocurrency, recommended a sell for Tesla, and they were quoted, "We question if this is not as good as it gets from a near-term upside surprise for shares." JP Morgan, a sell. UBS did change their opinion, sorta. While Tesla claims it will be profitable and cash flow positive going forward, we do not see that as likely with declining prices. Tesla also claims to have no plans for a capital raise. However, a view on a Q4 or 2019 capital raise is unchanged, as Tesla will need to invest to expand Fremont reduction, build a China factory, ramp Model Y, and expand infrastructure. So they went from a hard So they went from a hard sell to a soft sell, but still a negative. Now, the real issue here was the amount of these Tesla Model 3s being sold, which was over $3 billion. Currently, Tesla is at $348. Market cap is approaching 60 billion, and if you look at the past 6 months, here you can quite clearly see this decline. That was last month. And what happened here? It went from like 250 to over 350. What? Yeah, there was a lot of money made if you had some Tesla stock. We're going to return to another point in this video. What should analysts look at? The potentials of the company for, the next couple of years, the founders, the team, the technology, and how technology outside of the company is improving, not how much Tesla makes every single quarter, or any company for that matter. Wall Street analysts are embarrassingly bad at predictions. With stocks, analysts overvalue the sort of good financial news that could propel a company into becoming the next Google or Apple, which leads to too rosy predictions. Likewise, they also get too scared of bad news, fearing it will foretell the total collapse of a company, so they abandon ship. In reality, the top 10% of stocks seen most optimistically by analysts did have more companies that broke out and had skyrocketing stock growth, but overall most companies just weren't the next Google. It was discovered that investing in the stocks that analysts were most pessimistic in a given year about would have yielded an average 15% in extra returns, in stock terms a profit, the following year, compared to only a 3%. 3% return compared to 15. You had 5 times more money if you went against what they were saying. That's pretty crazy, right? You have profit either way. But which one seems more appealing to you? This one over here. Cryptocurrency has been many times compared to Amazon, which we know is slowly taking over the world, and they're approaching 1,700. They're at $820.3 billion. It's insane. So they did take a little bit of a decline, but if you look at the 5-year chart, they peaked over $2,000, and if you look at the maximum chart from back in the 90s, Amazon was at like $1.50 over here, right? And here you have it at 2,000. So if you bought 10 shares of Amazon back in the 90s when it first came out, which was like 15 bucks for you and maybe a couple bucks from the fees, and you sold it just a little bit underneath the peak at $2,000, you'd have 20 grand. 20 grand from like, I'll just throw in $16 here. How many of you in cryptocurrencies have thrown in $100, $1,000 at just random altcoins or crap coins, right, that just never spark? Now, there's so many thousands of companies that were like Amazon that just failed in the dot-com bubble. But if you didn't recognize its importance back in the 90s or in 2001 or in 2005 or in 2008, 2010, in the recent years, we've seen some major improvements with Amazon, but we're going to read something from a very, very long time ago. This is from 2000. This is from June. Now, Oliver Burkeman was very wrong on Amazon. This is from theguardian.com, a pretty big newspaper and website. Amazon.bomb instead of Amazon.com. How the internet's biggest success story turned sour. The pioneering internet bookstore he founded in his garage made him a darling of Wall Street. Then on Friday, Jeff Bezos saw the value of his company cut by a fifth. Oh no, it's the end of Amazon, right? Most people were expecting blood on the carpet, for last Friday was one of the oddest days to hear Bezos' optimism. He was quoted as saying, 3 years ago our stock was $1.50 a share. Today it's $30 something. There have been many, many days when our stock has gone up 20% a day. And if stocks can go up 20% in a day, they can go down 20% in a day. All internet stocks are volatile, including Amazon.com. We are nowhere near running out of cash, and we're not at all worried about it. His assistant says he's always like this, always optimistic. Amazon was taken to court in 1998, claimed to be the Earth's biggest retailer, which now, Mary Meeker, a street analyst, predicts losses of $96 million this quarter and $83 million next, and the firm sacked 150 people in January, its first redundancies. Until the beginning of this year, the Amazon story had almost seemed too good to be true. Time magazine describes Bezos as a visionary, a man who saw the future 5 years before the rest of us did. He has so much else to offer. In the interim, Bezos insists the company has no plans to fire any more people to cut costs this year. may slow down its rate of acquisitions, he says, because it finds little interest in the e-tailers that are in dire straits. In most cases, unfortunately, we're not interested because it's a question of what would we be getting. We have great technology and a great brand name. Bezos was quoted saying, most startup companies do fail, but most fail slowly. It takes 6 or 7 years for them to fail. As Amazon's 5th anniversary rolls around, Bezos may be wishing he hadn't said that. Oh, wow, that was a burn. Analysts predict Amazon will fail. I got that from looking into it, but there's so many other articles talking about that. And here is 2018. So if you compare this article, which says Amazon.bomb, compared to a Forbes article, 5 reasons Amazon will hit $4,000 by 2019 when it's under $2,000. Ha ha ho! Hosting the world's best CEO, creating a culture of customer value, growing through new products and acquisitions, aka taking over the world, turning capabilities into new profit streams. Cool! You can see the huge difference. Anyways, do you see any comparisons between Amazon, Google, Facebook, Uber, Apple to cryptocurrencies? My name is Michael Cabrera. That is for today's video. I just want you to think about that stuff. So next time you look at Bitcoin and you're like, well, it's at 4,300, or it's at 3,000, it's at 2,000, it's failing. Bitcoin's charts look very similar to Amazon, although Amazon's is a little bit more stable. But if you look at the long term, okay, sure, if it did have a very significant decline over here. But in the early days, years back, there was a huge bubble that burst with Bitcoin. People thought it was going to collapse then, and it went up to $20,000 years later. So just think about that.
Thanks so much for watching today's video. If you enjoyed it, please leave a like, comment, and subscribe. I want to hear your opinion. Start a normal discussion without the hate, and we shall see you guys tomorrow. Bye.